Hi, Joaquin. How are you?
Hey, Chris, how's it going?
Very good, thank you. We obviously had a huge night last night with the U.S. elections. So here we are. Trump has won. I guess just a few comments on this. I mean, it's quite outstanding. Whatever position you have politically, whatever you think about Donald Trump, we've talked about this in the past. He is, in my opinion, the Teflon man. Quite impressive. That it is an impressive thing that he's done to come back here through everything that's gone on. We put out a report recently about implications of a potential Trump win or a Harris win. Now we know, obviously, it's Trump, and so I thought we would go over what it meant. One thing I do want to talk about very quickly is that as I was going through Fox and CNN and Bloomberg and listening to the different reporters yesterday, and they were interviewing people, one of the things that was very much at the forefront from a personal level as they interviewed these people was the inflation story. That was something that, I mean, it was inflation. So I find this, the irony of this is that finally the Fed has been able to tame inflation, but Biden / Harris, I mean, by association, Harris lost because of this, what I think a big story, which is inflation. Mm-hmm. So any comments on that? Is that it?
Yeah, I would say, it's clearly been all about the rise in the price level. That's an important distinction because inflation has actually gone down, but it's not as though the price level has decreased to the pre-COVID path, right? I mean, you're in a situation where the cost of living has generally increased. I would sort of make two sort of comments related to that. The first one is that what's remarkable about yesterday's results is that they happen in a context of full employment. And it's very rare. It would be, if you go back to the post-World War II period, I think it would be very difficult to find a situation in which the incumbent has lost the election in a situation where the job market has been as tight as what it currently is and what it was over the last few years. So obviously that shows that the erosion of purchasing power seems to dominate in terms of people's perceptions in making decisions for their future leaders. That's one thing. Then the other thing I think is important is that the results should not be thought of in isolation. The consequence of high inflation has affected developed market politics in general. The switch in administration is something that we've seen across the G7 in the last couple of years. We've seen changes in government in Germany, in Japan, in Italy, in Australia. Canada is facing problems, so the Trudeau administration is facing problems. In France, the Macron government remained in power, but with a minority. And the commonality across all of this has been the increase in cost of living. And so that's something that, again, it's not specific to the US. It's something that I think applies across the board and just a consequence of the impact of COVID on developed markets.
Yeah, it's quite impressive in an environment where you have near full employment.
Absolutely.
Okay, so let's go back to the policies that Trump is going to want to or try to push through. As you know, it looks like, they have won the Senate. The House is still up for grabs. I think the odd makers are saying that they will get the House, but we'll wait and see on that. So the first point, I was reading this morning that the press secretary for Trump very quickly stated today that the day that they come into office, deportation is going to start. So the immigration story is a big one. We have tried to kind of simulate the potential implications of this. So that's one part. I mean, at a maximum, they're talking 11 million undocumented immigrants to potentially be deported, but we'll see. The second are tariffs, obviously a big one, 10% across the board globally, 60% specific to China. The third one, they're going to keep the TCJA tax cuts, those two which were supposed to be expired in 2025. That's pretty clear. They're going to keep that. What other tax cuts are they going to make? Most probably they will. We're not sure about their policies on that side. And then housing, I think from a Harris perspective, it was a lot clearer than what Trump was going to do. He's talking about potential things that he can do to kind of improve it, but I think we'll probably have to park that one. So let's talk about the three. Let's start with immigration, and then maybe go through tariffs and fiscal, and then kind of let us know which one has the biggest effect, and then obviously inflation is the big story here. Is it inflationary?
Yeah, so this is something we've gone through extensively in the last month. In fact, you and I did a video on this a few weeks back, and so I'm going to try and keep it short today just as a summary. But the general idea is that those three policies that you mentioned are generally inflationary in the current macro context of the US, which is one of overheating, right? And so because you're already running above potential, any one of these policies would likely exert considerable upward pressure on prices, even if the effect proves temporary. Out of the three, what we found was that the two most disruptive to prices were the first one is the 10% global tariff across the board. The distinction there is that China makes up actually a very small share of the overall consumer basket. So the effect in imposing a 60% tariff on China might actually be the indirect effect may be just as important because there's a lot of intermediate goods that come in from China. But the 10% tariff across the board basically gives no room for substitution, right? It's not like you can switch to other importers. You can switch to providers in Mexico or Southeast Asia, for example, as a substitute to what retailers are sourcing from China. And in a context, again, of strong private spending, it's a lot easier for importers to retain their markups and just pass on those cost increases onto consumers. So that we found was quite disruptive. The effect was a little under 1%, like 100 basis points for the full year. I think it was 2026 was the peak effect for that tariff. And then the second most disruptive effect was immigration. And the important thing to consider here is that undocumented immigrants make up a very large share of growth in labor supply in the U.S. And so if you remove that and reverse it, you will essentially tighten the job market more than what it is today. And so you would get this dual impact where you would have upward pressure on wages and labor supply wouldn't grow as much. And so potentially the unemployment rate would rise less than otherwise. One big reason why the unemployment rate has risen so far is because undocumented immigrants don't report jobs as much as documented immigrants do. And so that sort of kept participation rising faster than reported growth in jobs. So it's really those two effects that I think matter the most. And what they translate is in a situation in which the economy will likely continue to overheat for longer than it would have under Harris. Eventually, we do expect those inflationary pressures to dissipate, but just to give you a sense of the magnitude, and we may have to rerun these scenarios depending on what happens to immigration, but what we were expecting was the full year impact of all of these policies to translate into an alternative scenario for inflation of about 3.5% for full year 2026, and the effect would then die out. Obviously, in that context, I'm sure this will be your follow-up question, this does have important implications for Fed policy, right?
Yeah. So, I mean, there's two things. One is Fed policy. That's, as we wrote in our report, the curveball to the Fed, which really throws them a curveball. And then the second thing, which we quickly talk about, is the potential fiscal deficit that we could see in a Trump. I think we were talking about that the deficit will be most probably larger in a Trump with this Trump win, basically.
Yeah, exactly. So I think both of those things are obviously very important macro consequences. In terms of Fed policy, that alternative scenario we had generated with higher inflation, with Trump passing on the tariffs, and then with the reversal in labor supply, that we found translated into 4 less cuts than our baseline by mid 2026. What that would mean is that, absent those policies, we do find that the terminal rate will be lower than what the market is currently pricing, but converging towards 2% or maybe less, as we do expect the economy to decelerate and the unemployment rate to rise. But essentially, if the Fed is cutting 100 basis points less, then that would essentially mean that the terminal rate would be very close to the Fed's own perception of the neutral rate.
Yeah.
That's for Fed policy. And then for the fiscal side of things, I think the most important thing here to consider is what happens to long-term borrowing costs or long-term yields, right? So in the last month, so since odd makers started pricing in a higher probability of a Trump win, we've seen a sizable increase in long-term yields. The 10-year went up sizably, even if the Fed was pivoting. The magnitude of the increase in the 10-year yield is actually quite rare in the first month following a Fed pivot. You've had instances in which yields have risen because the market tends to price things faster. But we've had at this point, probably it's an 80 or 90 basis point jump since before the Fed pivot. If you decompose the factors that are behind that, what we find is that a lot of that move, about half, stems from a widening, what we call the term premium. And that's essentially the extra insurance that investors demand for holding long-term debt until maturity. That can be driven by a number of factors. It happens to coincide with the rise in in the probability of Trump winning. And so what underlies that, so our read is that is pricing in a higher projected deficit, right? And so there are worries around fiscal sustainability. Obviously, it will depend on the magnitude of the policies that he's pushing, but to the extent the deficit were to widen significantly, you could end up in a situation where long-term yields don't fall as much as they would otherwise in a context of a Fed pivot, which obviously has important implications for how you position your portfolio as an asset allocator, let's say.
Right. Yeah. So on that note, from a U.S. asset allocation perspective, our positioning has been the right positioning, which is long stocks, short bonds, and aggressively long stocks, basically relative to bonds. How does this? I think it's clear that we continue with this. Is this so tactically? Do we continue, and then more on a strategic, longer term, maybe 1 year out? Where are we?
Yeah, so right now we remain very clearly overweight equities. One thing that played out as we expected, certainly with the Trump win, the effect got amplified, was that we had a deep underweight on duration, and that has played out certainly in our favor. With the Trump win, and again, depending on the extent of the policies that are passed on, have a number of implications from a stock bond perspective. What it means is that it allows the risk reward profile of stocks to remain favorable for longer, basically, because there's a higher risk that bond prices won't go up as fast as you would otherwise expect in a Fed easing cycle. And so we had run an alternative scenario for the optimal positioning with this sort of 3.5% inflation rate, and what we found is that you had to remain at least mildly overweight equities, not just 3 to 6 months out, but even at a longer horizon, say 12 months out. So that's important. And then within the sort of bond mix, because inflationary risks would rise, then favoring inflation-protected bonds, so TIPS over nominal bonds, would also be something that we would favor in that environment. And then for the equity mix itself, it's not just about stocks versus bonds, it's also about the equity mix in terms of style and size. For style, it's not super clear. Whether a Trump win benefits growth or value, clearly we will talk about, I think, sectors in a minute. But for size, there is a big distinction. So small caps, where obviously they've underperformed large caps so far this year. But the current macro environment, I think, of a Fed pivot alongside resilient growth does favor small caps. We had actually opened a tactical long position under what we call special opportunities for small cap about a month and a half ago, so right before the Fed pivoted. The Trump win just improves the near-term upside on that. We've seen the Russell 2000 rise a lot this morning, and what's behind that basically is that like the tax cut effect is perceived to be a lot more favorable towards small caps. And then the other thing that's important is that small caps, especially those that trade in the Russell 2000, which are sort of lower quality small caps, they mainly have a domestic exposure. They don't really have international exposure. And so if the dollar strengthens, they're essentially shielded from that effect, whereas larger firms would not be, because obviously a lot of their earnings stem from foreign sales.
So just one question on that. One comment on our bond positioning right now. Again, yesterday I was looking at, what's the historical spread between Fed funds and the 10-year, and historically it's anywhere between 100 and 150 basis points. We're not there. The steepening could, we could continue to see that, which that in my also kind of argues for maybe even higher bond yields than we currently have.
Yeah, I mean, we certainly are envisioning a situation where the yield curve continues to steepen from here on. A very rapid steepening is usually associated with recessions. That's usually what you get in downturns. And so how you position your portfolio in sort of in response to that signal, timing is probably important, because again, if the yield curve were to steepen significantly, that usually is associated with a situation where expectations of growth deteriorate significantly. And so that is important to consider in terms of managing your portfolio in terms of equity against bond positioning.
And then on small caps, the Russell 2000, one of the fears that you hear out there is that, yields are going up. It affects them greatly. Mm-hmm. We were talking earlier about this, and you're not too worried about this.
No. So I looked at it after we talked. We had run sensitivity analysis on this some months back, assessing basically the rate sensitivity of small caps against various large cap sectors or styles. Basically, what we find is that it's more sensitive than value cyclicals in general within the S&P 500, but it's less so than growth stocks in the S&P, which are very sensitive to changes in the discount rate. So the sensitivity in the case of small caps basically comes from the fact they carry a lot of floating rate debt. But the thing to consider here is that as long as the economy remains resilient, default risks will likely remain low, right? And so it's a very similar type of argument that you would make for holding corporate debt over sovereign debt, let's say, right? So as long as default risks remain low, I think the risk of rising long-term yields through a widening term premium are contained, and the activity effect would dominate. And so for now, at least, we are bullish on small caps.
Right, and they're cheap. So
absolutely.
Yeah. Okay, so when we look outside the U.S., implications, obviously, now with the tariffs, I think globally there's implications everywhere. I thought we'd look at three specific areas. One, emerging markets.
Yeah.
Two, Germany specifically, because it's such a large economy. Mm-hmm. And then Canada, because it's the neighbors of the U.S. Yeah. So maybe start with EM.
So for EM, look, in general, we've been bullish about EM in the last 6 months. That has played out in our favor. We've, in the last week or so, as the likelihood of Trump winning rose, we send a number of notes warning clients that, EMs could experience a temporary hit. They did so greatly in 2016. And the important thing to consider here is the dollar effect. So EM equities in particular are very high dollar beta. And so a context of a strengthening dollar in expectation of protectionism and less Fed easing, let's say, is especially unfavorable towards EMs. The overall impact on EMs should prove temporary. That was actually the case in 2017. So they first underperformed, but then, that effect died out. There are differences across EMs, and within that space, we're especially concerned about Mexico. Mexico has a very deep exposure to the U.S. They have a large manufacturing base. They rely heavily on the U.S. as an export market. Right now, the current presidency under President Scheinbaum is, a lot more left-leaning than it would be under Trump. So you could even envision a situation where country risk were to go up in expectation of deportation or global tariffs. And so, again, the 2016 experience is a great blueprint from this. EM currencies in general fell about 5% against the dollar 2 months after Trump won. The Mexican peso fell close to 20%. And so that's, I think, an avenue. If you have the ability to short or maybe buy put options on the Mexican peso, then that I think is an avenue that could prove attractive. In terms of Germany or offshore DMs, just for now, I think we would generally favor more of a DM to EM tilt. Germany, though, is an economy that, well, in general, it has a very large global footprint, and so the sensitivity to a strong dollar is higher than it would be for other developed markets. And so, in general, that effect wouldn't be as disruptive as it is for EMs, but it is something to consider. Right. And then more generally, we just find that the DAX is completely detached from fundamentals right now, right? So the performance of the German economy is extremely poor. I understand they are global companies, and so it's not a one-for-one mapping with what happens in Germany. But historically, the performance of the DAX is actually strongly linked to Germany's industrial cycle, because that drives flows into and out of Germany, right, relative to other markets. And so right now, there's a very large disconnect between where the DAX is trading and what sort of the estimated fair value that would be consistent with macro fundamentals would suggest. And so historically, when that gap between any measure of economic sentiment in Germany versus German stocks is as wide as it is today, it's historically the DAX loses about 10 to 15% over the next 12 months. And so that is something that's something we're looking into as a big research piece. And so there's going to be more on that in coming weeks from us. And then finally for Canada, for Canada, I think what really matters here is, there's two things. One is differences in terms of economic performance. The Canadian economy is doing a lot worse than the US is. And so that generally would encourage flows away from Canadian assets and towards US assets, which would put downward pressure, among other things, on the Canadian dollar. And then the other thing is the interest rate differential, right? So that's widening. It's widened, because the Bank of Canada is cutting faster and more aggressively than what the Fed is. We expect that to continue. And then secondly, long-term yields in the US have actually risen even after the Fed has pivoted, right? So as long as that interest rate differential remains and potentially widens, that would likely exert downward pressure on the loonie. Again, I don't think it would be an effect. I don't think the effect would be as aggressive as on emerging market currencies, but directionally it would probably.
Well, and especially for clients that can't invest in emerging markets, I think the Canadian play here could be interesting. I mean, the loonie now, if you strip out COVID, it's at lows that we haven't seen since the early 2000s. The other thing is that Trudeau, the prime minister, has imported growth because immigration basically has been extremely strong in Canada over the last couple of years. Last year, 1.3 million population growth, 98% of that came from immigration. He is now doing a 180. They're diminishing these policies or dropping the number of people that they will be letting into Canada. That could have big implications for the economy. There's a lot of people out there saying that if you stripped out immigration, Canada was in recession in 2023. Yeah. So more to come. We're going to actually be writing a report on this in the coming days, weeks, and so on. And then lastly, from a sector basis, we talked a little bit about this in some of our, some of our reports recently. But more specifically for banks and aerospace and defense, I think these are two sectors that could have some kind of major implications with have major implications with the Trump win here.
Yeah, exactly. So banks in particular did exceptionally well in the first 6 months after Trump's win in 2016. At that time, what drove the demand for banking stocks, and this applied for both large diversified banks and smaller regional banks, was the expectation that under Trump, you were going to get a lot of the government was going to roll back a lot of the post-GFC regulation, like the Dodd-Frank Act, that sort of thing, that hindered lending growth. And so there was an immediate shift in fund flows towards banking. It's a sector that did exceptionally well especially in the first 3 months after the win. This morning, you're seeing a move towards both regional and diversified banks as well. I think for the current macro context is also probably favorable, especially to regionals, I would say. You still have strong activity. The fact that the yield curve is normalizing helps them as long as activity remains strong, because their margins depend on the spread between long and short-term interest rates. And so, specifically for regionals, they're trading well below fair value still. So obviously they took a big hit after the Silicon Valley episode last year, but they've remained trading up below fair value. And so it's a sector that, from a valuation standpoint, you could see a rotation as investors expect a re-rating. And then the final one you mentioned is aerospace.
Just one comment on banks. One thing that I've been reading as well is that M&A was at all-time lows in 2023. I think there's a lot of people. There's still 2,500 regional banks in the U.S., a large number. So if this picks up, which I think a lot of people are looking for a pickup in M&A, you saw some pickup in 2024, not a huge amount, but some. That could also help regional banks.
Absolutely. And then finally, you asked me about aerospace and defense.
Yeah.
Aerospace and defense falls under capital goods. That's a sector of the equity market that I think should benefit in general from a rotation in fund flows towards domestic manufacturing, right? And so, because a lot of these A&D firms rank highly in industrial ETFs just because of their size, that would in general benefit them in expectation of global tariffs, let's say. But then there's sector-specific factors at play, right? There's the fact that the perception of increased military spending would probably also drive demand for military contractors. The bulk of aerospace and defense is made up by military contractors, and so that obviously should prove favorable. And then, in addition, what we find is that right now, this is a sector that is trading at a discount, given the amount of geopolitical instability there is globally, and actually the amount of spending there currently is in equipment for aerospace and defense, both military and civilian, right? So it points to a much stronger price level than what we're seeing today. And so again, this increases the chances of rotation in fund flows towards that sector. And so it's A&D and banks that I think probably have the highest upside at a sector level immediately, I think, on a tactical basis following
that's great, Joaquin. Thank you very much. Obviously, we're going to look over the next hours, days, weeks to see if Trump actually or Republicans take the House. That's going to be a big factor in his ability to implement some of these policies.
Yes.
So I'd like to do another follow-up in the next couple of weeks if we can. This was great. If anyone wants some of these reports that Joaquin's team put together over the last couple of weeks with all these simulations that are really cool, just reach out to myself or Jackson, and for sure we'll get you the report. We'll talk soon, Joaquin. Thank you very much.
Bye, Chris. Bye.
Bye-bye.